Imagine investing your hard-earned money into something you believe is safe and passive, only to realize you're trapped in a hidden web of active investing. Sounds scary, right? Well, that's exactly what's happening with millions of index fund investors right now. I'm Matt, a chartered accountant and finance expert, helping you make smarter money decisions. Today, we're diving into something I've personally recommended many times, index funds. But lately, there's been growing concern from my perspective and real evidence that index funds aren't exactly what they seem. They're supposed to be passive, safe, and diversified, but in reality, many investors are unknowingly taking massive risks. Stick around to understand why, and more importantly, how you can avoid falling into the index fund trap. Let's start with something surprising. Many index funds aren't actually passive. Now, don't get me wrong. Index funds were brilliantly designed by John Bogle, founder of Vanguard, who introduced them to the world in 1975. His revolutionary idea was simple. Don't try to beat the market, just track it. However, the financial world quickly found ways to muddy these clear waters. Here's the reality. There are roughly 10,000 index funds globally, but many aren't generally passive. Asset management companies often create their own indices, tailor-made to market trends and investor sentiment, disguising active bets as passive products. A groundbreaking paper called Passive in Name Only uncovered that nearly a third of index funds today track indices created by the very companies managing the funds. This deceptive practice is widespread. Imagine investing in a high dividend AI growth fund. Sounds appealing. Yet often these indices are simply marketing gimmicks to attract retail investors who believe they're getting passive exposure. Instead, you're unknowingly making active bets on specific sectors or trends, eroding the core benefit of passive investing, simplicity and diversification. So what's the takeaway? Always dig deeper. True passive investing requires investing in a broad market indices, like the Vanguard Total World Stock ETF, which holds thousands of global stocks. Now, let's explore the next hidden danger few investors consider: concentration risk. You may assume that buying an index fund means your investment is evenly spread across numerous companies. In reality, many major indices today are heavily weighted towards just a few massive corporations. Take the iconic S&P 500, for example. Today, the top 10 companies, tech giants like Apple, Microsoft, and Google, make up over 30% of the index. Historically, similar levels of market concentration have occurred only twice before, in 1973 and 2000. Both instances were followed by prolonged market downturns. Globally, the scenario is even more alarming. Fidelity recently highlighted that the 7 largest tech companies, dubbed the Magnificent Seven, now account for over 20% of major global indices. This isn't necessarily bad if these companies continue to thrive, but historically, no company remains dominant indefinitely. For instance, only 52 companies from the 1955 Fortune 500 are still around today, meaning 89% have either merged, shrunk, or disappeared entirely. This risk is critical. Investors heavily weighted towards a few dominant stocks could experience significant losses if these giants falter. Diversification across sectors, regions, and asset classes becomes essential to generally mitigate this risk. Perhaps the most significant yet overlooked risk of index funds isn't the funds themselves, but in investor behavior. Many start off passive, intended to buy and hold indefinitely, yet unintentionally slide into active management practices. Research from Morningstar consistently shows that index funds investors underperform their chosen funds by 1 to 3% annually due to behavior-driven decisions like market timing, chasing performance, or switching funds based on trends. This phenomenon is akin to starting a strict diet, but occasionally indulging in cheat days. Before long, discipline just slips entirely. When you allow yourself small deviations from your strategy, discipline erodes, ultimately undermining your entire approach. Similarly, the illusion of diversification can also trap investors. Many hold multiple overlapping index funds, creating portfolios that seem diversified, but actually expose investors to significant sector or company-specific risk. The critical insight here is that passive investing isn't just about selecting passive funds. It demands a passive mindset, one that remains consistent, disciplined, and resistant to short-term market pressure. Given these risks, how can you invest safely and effectively? Firstly, scrutinize your index fund choices. Opt for more broad market indices that generally represent the global market. Vanguard's FTSE All World or Fidelity's Global Equity Trackers are excellent examples of true passive investments. Secondly, manage concentration risk proactively. Diversify beyond equities into bonds, real estate, and perhaps commodities or alternative investments. A diversified multi-asset portfolio can protect you significantly during market downturns. Finally, and perhaps most importantly, embrace the passive investing mindset wholeheartedly. Set clear investment rules and stick to them. Periodically, you need to rebalance your portfolio to maintain intended asset allocation rather than reacting impulsively to market events. In other words, successful passive investing requires discipline, diversification, and genuine understanding of your investments. It's not about doing nothing, it's about actively ensuring your investments remain truly passive. Now, I want your thoughts. Were you aware of these critical issues with index funds? Drop your experiences in the comments below. If this video helped you clarify your investment approach, please smash that like button. It helps me spread this vital information. Subscribe for more insights that empower your financial journey.